For decades, the path to financial security followed a simple formula. You secure a steady 9-to-5 job, carving out a slice of your paycheck, and park the rest in a standard index fund to earn a comfortable retirement. In the economy of 2026, that sequence of steps has broken down for the average worker. Severe inflationary pressures and quiet shifts in central fiscal policy have rewritten the math of wealth accumulation, largely without public notice. Relying entirely on this traditional mindset now creates an active risk, guaranteeing a slow, invisible erosion of your actual purchasing power. This erosion stems from how modern central bank interventions expand the money supply to manage national debts, driving the cost of living upward while average wages remain stagnant. This chart compares a savings account against 2026 inflation. Earning a 3% yield while living costs rise 7% means mathematically losing capital daily. Standard index funds also show synchronized dips during new fiscal policies, proving they no longer provide a sufficient buffer. Analysts define this dynamic as a diminishing return cycle, an environment where the yield on safe investments consistently falls below the depreciation of the currency. The middle class is currently playing a linear game with rules that prioritize capital drainage. Escaping this loop requires a new framework for asset allocation. To bypass this trap, the wealthy utilize a specific technical skill: decentralized risk management. A typical 9-to-5 job operates on a 1-to-1 ratio, trading 1 hour of labor for 1 hour of pay. Decentralized risk management replaces that linear model with nonlinear growth. This strategy focuses on asymmetric bets. Your potential loss is strictly capped at a small amount, but your upside potential exponentially expands. By limiting downside exposure while holding massive growth assets, a single successful allocation can outpace a decade of index fund returns. When the money supply expands at its current rate, mastering this asymmetry becomes the only mathematical way to keep your purchasing power ahead of the curve. Digital assets serve as the first mechanical tool for executing these asymmetric bets. Because decentralized networks distribute value across independent nodes, the hard-coded supply mechanics remain intact, even when a central bank's fiscal policy fails. This structural independence allows these assets to act as a resilient hedge. As fiat currencies lose purchasing power, capital flows into algorithmically capped digital assets that exist outside the centralized system. Investors manage this asset class as a non-correlated volatility hedge, using small allocation sizes and periodic rebalancing to capture high growth spikes while protecting the broader portfolio from currency devaluation. The second vehicle for asymmetric growth involves high-leverage equity and intellectual property. Most traditional passive income streams, like physical rentals, still require continuous maintenance and time-based management. Intellectual property, such as software or digital rights, generates revenue across multiple channels simultaneously. As the flowchart shows, the earning potential runs independently of the time input clock. Wage growth is limited by the hours you can physically work in a day. An IP or equity portfolio scales endlessly because digital rights operate without biological constraints. Combining these infinitely scalable equity vehicles with decentralized assets is what finally severs your financial trajectory from the limits of a traditional workweek. A resilient portfolio in the late 2020s centers on verifiable digital data drives and enforceable patents, moving away from the physical storage of paper currency. If a market shock devalues traditional stocks, the decentralized digital assets provide a stabilizing floor, while the intellectual property continues to generate automated cash flow. This decentralized framework thrives on volatility. As economic panic drives more capital into limited supply digital assets, the value of the resilient portfolio increases, while traditional cash holdings stagnate. Long-term financial security now requires abandoning the safety of centralized cash hoarding in favor of this asymmetric blueprint. The wealth divide of the late 2020s is driven by asset allocation strategy rather than labor intensity. Those who stay within the standard savings mindset will see their long-term financial mobility move permanently out of reach as the old system slows down. To survive 2026, you must shift your perspective and prioritize high-leverage growth vehicles now, before the current economic policy shifts complete the stagnation of traditional capital.